Ladies and gentlemen, good day and welcome to Gland Pharma Limited Q4FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sumanta Bajpayee, Vice President, Finance and Investor Relations. Thank you, and over to you, sir.
Thank you. A warm welcome to Gland Pharma's earnings call for fourth quarter of financial year 23. I have with me Mr. Srinivas, Managing Director and CEO, Mr. Ravi Mitra, CFO, to discuss business performance and to answer queries during the call. We will begin the call with business highlights and overview by Mr. Sadu, followed by financial overview by Mr. Mitra. After the opening remarks from management, operator will open the bridge for Q&A session. Our earnings presentation has been submitted to the stock exchanges. It is also available on our website. Before we proceed with the call, please note some of the statements made in today's discussion may be forward-looking and are based on management estimates, and these must be viewed in conjunction with risks and uncertainties involved in our business. The safe harbor language contained in our press release also relates to this conference call. This call is recorded and the playback shall be made available on our website shortly after the call. The transcript of the call will be submitted to the stock exchanges and made available on our website. I now hand over the call to Mr. Sadu for his opening commentary. Thank you. Over to you, sir.
Thank you, Sumanta. Good evening, everyone. Thank you for joining our earnings call for the fourth quarter and full year 2023. My best wishes to all our shareholders, analysts, and their families. We have formally closed the acquisition of Cenexi and welcome you to be a part of the Gland Pharma family. This is our first overseas acquisition and our move into the next phase of growth and expansion. This acquisition is aimed at expanding our CDMO offerings in the European market. It is in line with our strategic roadmap of building a European manufacturing presence in sterile injectables. It provides access to leading know-how and development capabilities in sterile forms, including vials, pre-filled syringes, and other innovative technologies such as ophthalmic gel and needleless injectors fill finish. It will help us establish our presence into the branded CDMO space and biologics. Our priority is to focus on a seamless integration of businesses. We made progress on our path to building a biotech CDMO and signed our first contract for plasma protein at our Shamipet facility. We are also in advanced stages of other discussions and biosimilar opportunities. I must say it is a testimony to our strength and the robust infrastructure installed at our facility in Shamipet. We closed this quarter, Q4FY23, with a revenue of rupees 7,850 million as against rupees 11,030 million in Q4FY22, and our PAT stood at rupees 787 million for the quarter against rupees 2,859 million in Q4FY22. Our full year FY23 revenue stood at rupees 36,246 million, a degrowth of 18% over FY22. Our full year FY23 PAT stood at rupees 7,810 million against rupees 12,117 in FY22. We have generated rupees 3,640 million of cash flow from operations in FY23. The performance has been subdued because of lower sales on some of the key products during the current year as compared to previous year. Cenexi facility shutdown was taken for capacity expansion. Strategic shift at some of our customers has impacted revenue. We have initiated an action plan by transferring some of the products to other customers. We are focusing on ensuring the supply continuity across our portfolio of products and have stocked up inventory for key products to avoid any material shortages. We completed 9 ANDA filings during Q4FY23 in line with our filing plan. We made further investments in our R&D this year and were able to make 29 ANDA filings during FY23. As an important milestone, we received our first China approval and have also initiated launch of our product Extrazosine. We should receive another 3 to 4 product approvals in China during the year. Our progress on the complex portfolio is also going strong, and this year we filed a total of 3 complex products during the year. During Q4FY23, upon excluding capital R&D expenditure, the R&D expenditure stands at rupees 603 million, which is 7.68% of the revenue for the period as against rupees 443 million during the previous quarter. For the full year, our R&D expense stands at rupees 1,845 million, which is 5.09% of the revenue for the period. As on 31st March 2023, we along with our partners have 334 NDA filings in the US and 1,601 product registrations globally. We continue to hire the right talent at our US subsidiary, strengthen the business development initiatives, and building new partnerships. We are also strengthening the plant operations team with new capacities coming online. This year, we again saw physical audits start after the halt due to COVID. We have successfully completed US FDA audit with no observations at our API facility in Vizag. We continue to invest in constant improvement, and our teams across all our sites remain prepared for any regulatory audits. Let me summarize our performance across various geographies. Our rest of the world markets account for 22% of our Q4 FY23 revenue against 17% during Q4 FY22. Our full year FY23 revenue for these markets stood at 6,894 million as against 8,481 million in FY22. We maintain inventory of raw materials and packing materials to be able to cater to the demand. We continue to register products in new geographies. Our key markets continue to remain MENA, LATAM, and APAC. Our core markets, namely US, Canada, Europe, Australia, and New Zealand, accounted for 70% of our revenue, as against 64% in Q4 FY22. Our full year FY23 revenue for our key markets stood at rupees 26,851 million, as against rupees 29,248 million in FY22. Part of our new launch product portfolio, we have shipped out 10 product SKUs during the quarter. We are constantly working on improving material availability and resolving any production delays. India market accounts for 8% of our Q4 FY23 revenue. Our full year FY23 revenue for Indian market stood at rupees 2,501 million as against rupees 6,278 million in FY22. We saw impact from normalizing of COVID-related sales in the Indian market. We are focusing on integrating the business and connecting with Gland and understand the importance of a seamless integration. Our focus is on leveraging synergies between the businesses to generate stakeholder value. This acquisition has the potential to drive value creation over the years to come. In this, I wish everyone good health. I would like to now hand over the call to our CFO, Mr. Ravi Mitra, who will share details about the financial performance for the quarter and full year 2023. Thank you.
Thank you, Mr. Sadhu. Good evening, ladies and gentlemen. Thank you very much for attending our fourth quarter and financial year ending 2023 earnings call. Our earnings presentation has been uploaded on the website. Let me begin by sharing the financial performance of the quarter and financial year of 22-23. For the fourth quarter, we have reported revenue of rupees 7,850 million, a reduction of 29% on year-on-year basis. Revenue from operations for fiscal 23 stood at rupees 36,246 million, a year-on-year decrease of 18%. Key reasons for reduced revenue during the year are inventory rationalization across customers in the US market, high price pressure with increased competition impacting revenue, and higher base of last year due to COVID-related product sales. In terms of bifurcation of revenue during FY23 as per markets, core markets comprising of the US, Europe, Canada, Australia, and New Zealand have contributed 74%, followed by ROW market adding 19% of revenue. India contributed balance 7% of the revenue from operations. Our core market has seen a decline of 23% during fourth quarter of FY23 as compared to same period of last financial year. It has registered an 8% degrowth during the financial year. ROW markets have witnessed a reduction of revenue of 10% for Q4 FY23 and 19% degrowth on a full year basis. India market declined by 68% for Q4 FY23 and 60% for FY23. Other income for the fourth quarter was rupees 389 million which includes interest on fixed deposit and foreign exchange losses in operation. For FY23, the other income was rupees 2,405 million, of which interest on fixed deposit was rupees 1,794 million, and foreign exchange gains on operation was rupees 571 million. Gross margin of the company improved during the quarter as compared to same quarter previous year. Gross profit margin has improved for the year as compared to the previous financial year, largely due to favorable geography mix. We have reported an EBITDA of rupees 1,684 million in Q4 FY23 compared to rupees 3,484 million in Q4 FY22, which is a decrease of 52%. EBITDA margin for Q4 FY23 stood at 21% as compared to 32% for the same period of the previous financial year. EBITDA for the full year ended March 23 was rupees 10,248 million compared to rupees 15,102 million for the previous financial year, a decline of 32%. We have reported EBITDA margin for FY23 at 28% as compared to 34% of previous financial year. Power and fuel costs have gone up 17% in Q4 FY23 and 31% in full year FY23 due to increase in power tariff and oil and gas prices. Employee costs have increased by 9% in Q4 FY23 and 19% in full year FY23, largely due to additional headcount to support the new production lines in Pashamylaram plant and the bio-CDMO facility in Chamarpet, as well as the annual increment impact. Other expenses increased by 11% during FY23 as compared to the previous year, majorly due to the increase in professional fees paid for the M&A. The total R&D expenses for the financial year 2023 was rupees 2,014 million compared to 2,273 million for the previous financial year, which is a decrease of 11%, which stands at 5.6% of the revenue. R&D expense for the fourth quarter was rupees 678 million, which is 8.6% of revenue, compared to rupees 559 million in the previous financial year. The increase in R&D revenue expense is due to the higher number of ANDAs and DMF filings during the fourth quarter. The higher percentage of revenue is due to the lower revenue base in Q4 FY23. Our net profit for the fourth quarter was rupees 787 million, a significant reduction of 72% compared to Q4 FY22. During the financial year 23, our PAT was rupees 7,810 million, which is a decrease of 36% as compared to last year. We have reported PAT margin of 10% for Q4 FY23 and 22% for full year FY23. Subsequent to year-end, one of our customers filed for Chapter 11 bankruptcy in US, and hence we have provided the outstanding balance of 565 million rupees and has disclosed as an exceptional item. Our effective tax rate was at about 29% in the fourth quarter and 26% for the fiscal year 23. Though the gross profit margin improved over the previous year, but due to meaningful reduction of revenue over the same period had negatively impacted EBITDA and PAT margins. Some of the measures related to cost reduction and efficiency improvement are being undertaken and will have favorable effect on margins. Cash conversion cycle stood at 256 days for the financial year 2023 as compared to 180 days as of last financial year end. The increase in working capital was due to higher inventory and receivable level. Increased receivable and inventory days have pushed the overall cash conversion cycle. We are actively monitoring both our receivable and inventory position for improving our working capital and operating cash flow. Total capex incurred during the financial year ended March 31st, 2023 was rupees 2,230 million, used for increasing API and formulation capacities. We are adding new capabilities for combi line, for microsphere, additional bag line, and layers for the pen and block in Pashamylaram facility in Hyderabad. Our ROCE on ex-cash basis as on 31st March 2023 stood at 17% and fixed assets turnover at 2.6x for FY23. As on March 23, we had rupees 37,707 million of cash, part of which we have utilized subsequently for Cenexi acquisition. As we have completed the acquisition of Cenexi, we are now moving forward from pre-closing activities to post-acquisition integration stage. We are gearing up for the dedicated efforts for seamless integration of both companies and realization of synergistic benefits. On this direction, apart from forming a dedicated team for PMI from both Gland Pharma and Fosun Pharma, we have also engaged with a global management consulting firm. With this, I would request the moderator to open the lines for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rushabh Shah from O3 PMS. Please go ahead.
Hello, am I audible?
Yes, you are.
I have a couple of questions. My first question is, since there are many companies, we are seeing new age companies entering into the CDMO business, and due to that our company has having a lot of problems. So how are you going to tackle with such an intense competition entering into the CDMO business?
Mr. Saurav, it was difficult for us to comprehend your question. Can you please come again?
It seems so that there are many companies entering into the CDMO business. How do you going to tackle such an intense competition business?
Members of the management, were you able to hear the question?
I think the question is related to the competitive landscape, right, in the present scenario. Am I right, Mr. Rishabh?
So my question is, in the new companies entering into the CDMO business, how are you going to tackle with such an intense competitive environment?
Yeah, so if you really see the pure development come B2B business landscape, still I think not many players are there. We could see some CMO players coming in and manufacturing products for companies. But our own model where we develop products and license out, still I think there is not that much competition like before. But yes, in terms of companies who are developing the products and trying to outsource like contract manufacturing, there is a competition, there is a price pressure. And if you look from our strength perspective, from regulatory side or from quality side, we're maintaining claim record, and that should sustain us in the long run compared to newer players. Where you're able to see the current regulatory inspection, how they're going on, and whether they could sustain with low margins in the longer run. Especially in injectable business where capex is very high and maintenance are very high. With large, with the low margin competitive landscape, survival in the long run could be difficult. So I think the time will come when companies have to rejig the margin profile so that they can invest into future growth or allocating investments into future growth as well as maintaining the flexibility of the FDA standards.
Okay, thank you. And since as our business is so much focused on CDMO and CMO business, if you could help me out with the percentage of repeat orders which you are receiving from the customers?
You mean the repeat orders from the customers?
Yes, from the customer. What is the percentage of the repeat orders we are getting?
So if you look at from a volume quantity perspective, our FY22 and 23 volumes are almost similar. The degrowth has happened from specific few products and as well as COVID-related products. If you see our domestic sales last year compared to this year, we lost almost 380 crores, mostly pertaining to the COVID sales that happened last year. And also one of our largest products, microfungin, which we had the initial exclusivity, it went down from almost 440 crores to 65 crores. That has actually, beaten the numbers a bit because we lost about 370 crores there. So these two main factors have contributed to the degrowth of 750 crores. But then there are also products where we have grown, products like Retapen, and we doubled our revenue. There is also a degrowth in heparin. Again, that was a COVID-related product. So in terms of the degrowth has happened specifically for 3 or 4 major products which got hit. I think it's a combination of COVID as well as the exclusivity what we got on the product. But on the majority of the products, still we are able to maintain that unit. While there is a pressure on prices, still the units have gone up. If you really see the breakup of the revenue bridge, what you see, normally our new product launches help us to grow about 10%, but this year it only contributed 3%. That shows a bit of competition in the market when we launch our products. So that has not contributed substantially. It's a combination of what products we sold, also the competition at which people are launching at the patent expiry date.
Okay, and sir, since the majority of your business is in USA, what do you think about the growth in India? Are there any plans to grow in India?
Again, so that's been a plan, but if you see now we are focused on injectables, and most of the injectables in India are tender-driven business. Also, a lot of products come under price control. And with the facilities what you run, it's very competitive in terms to compete in this space. While we are looking at some opportunities specifically on margin-driven products, but because most of the portfolio falls under the controlled price control, so that's been a deterrent for us.
Okay. If I could squeeze just one more in.
Sorry to interrupt here. I would request you to please come back in the queue. The next question is from the line of Kartik Mehta from Clay Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. I just want to understand in terms of base business, while there will always be competition and it's not something which we don't see in the industry. What is your assumption for reaching stable rate of revenues per quarter, even if it is on a half yearly or an annualized basis? The problems which you mentioned in terms of competition, new products not competing more. We need to get some color from you from the perspective of are there new products which will compensate for this while your gross margin continues to remain where it is? What is it at the expense side, or is there any large product which you expect? And also in terms of the broad revenue guidance, in terms of the fact that you will also be acquiring, you will also be integrating an asset.
So from the business perspective, like I said, the major products got hit. So to cover that loss, it takes a lot of other products to get launched which are smaller. So if you look, like I said, from the units perspective, it's still maintained at the company level. So the volumes have grown in some of the products, but specific products where we lost business to. Now, there are several large molecules which will be launched. But looking at the last year's experience, if you see even a $500-600 million product after they launched, it got, the prices got down almost 80 to 90%. There was a crash when it got launched. Now, whether it's sustainable in the long run, we can't say, but that's been the case. So we can't really vouch for the products. The big products will do well under this competitive scenario. But we have almost 28 products which got approvals this year, and that approval, the filings are on track, and all the facilities are on track in terms of supplying these products. And in terms of margins, you can see we have invested heavily, and some of the lines are not on commercial scale yet. Whether it is biologics plant, whether it is some of the nitrosphere lines we have established recently, and the 2 other lines they're still under approval process. So that's actually added up to a cost. But then we have filed several products on a transfer from other lines. this will get commercialized again, so that should increase the revenue. And with Cenex's acquisition, there are a lot of opportunities opening up in terms of the same customers who we are working in the US, where they're sourcing products from European other CMOs for the European market. We are working with them how to shift those kind of volumes to either the Cenex site in Europe or fill bulk in India and then move there. So in a longer run, we see the business is strong, and with the kind of portfolio we have and with the kind of distribution and contracts we have across the globe. But there are headwinds in the short term, like we said. But it's getting stabilized. When we lose such large molecule and take a hit of 40 crores, it does take few other products to take that load, and that's what we're working on.
Would you want to give some color on the broad revenue guidance, combined entity, if not for, if possible, throw some color on the China approval and the opportunity, if any, that comes in, that one can see in the revenue upside in FY24?
So Karthik, Sumanta this side. We have taken a kind of a conscious position given the volatility into the market as well as our past experience on the product. We refrain from giving any kind of a direction either on the top line or on the margin profile side of it. That is point one. Also, I'd like to highlight here that in the previous question, Mr. Sadhu has indicated 380 crore of thing. This is an assessment, this is an assumption, because of some of our products being used for COVID and non-COVID as well. So it is not like a verified number. Just for clarity of everyone, it is assessment. Management assessment could be kind of an impact on the domestic side of it.
Yeah. Okay. So, without talking about the guidance, any color on the business, and I'm not talking here in terms of the numbers, product approval likely for launches in this year and next year? Thank you.
So next quarter, we have almost 11 to 12 products which are getting launched. Like Mr. Ravi said in his speech, we have a customer who's going through the bankruptcy process where we are trying to move those products as well to the customer. There are also several opportunities where, because of the pressure, large customers are transferring their products to our side, so which could see some good business in terms of unit and numbers in the second half of this year.
China in particular, would you want to just probably highlight?
It's too early to comment on the numbers. I would say the first is
the numbers in terms of the number of launches. We have an idea about how the market is.
We're launching one product. This quarter. We just shipped out, and then 3 or 4 products are expected in the next 9 months.
Thank you.
Yeah.
Thank you. The next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, hi, good evening. Just on the current status, you mentioned, Q4 has been impacted by closure of some lines, the tenants. So what is the current status of all the lines during this quarter and next 3 months? Do we expect more closures, and the earlier ones have been resolved? If you could clarify that.
So the past quarter we have, as a part of a capacity expansion, we have closed a component line, which is because we're not able to cater to the demand. So we added one more license to that. So May 15th, we have opened up that. So the commercial production started again on that line. So that's the only line which got shut down. That's specifically to add one more layer because we've been contemplating that for a while and we're not able to meet the demand, so we took that call.
So one more line has been added apart from the one line which is restarted from May 15. Is that right, or?
We had 2 layers before. We added one more lyophilizer to that line. So that's why we had to take a shutdown for that.
Okay, so now 3 lines are operational is what I understand.
3 layers, yeah, correct.
Okay, lovely. And in terms of, you mentioned about, last quarter, you will not mention about guidance, but I'm trying to understand that gross margins are there. Inventory rationalization is largely done by the customers, or you think there is more inventory in the system?
I think a few products, I think one more quarter it will be there that most of the customers have rationalized. And that's the reason, while the end market volumes have not come down for us, for most of the customers. If you look at one of the largest products, we sold 50% of actually the end market number of units. So that should get back in a few quarters. So other than that, I think most of it should get rationalized. Yeah.
No, so inventory is volume only, no? So I'm a little confused here.
Yes. Inventory at the front end customer level. Because they were maintaining a higher inventory levels earlier, but because of the high interest costs and everybody is rationalizing their inventory, they're depleting to a lower levels. Some customers used to maintain 9 months to 12 months inventory because if you have a GPO NES contract, they have to maintain minimum 6 months inventory. But now with the high interest costs, they're trying to reduce their inventory at the level. So our transfers from our facilities to them was reduced. That's impacted our business a bit. But the end market wise, still the sales are robust in many of the products.
Okay, understood. So demand is there, but in general there is a destocking or a reduced inventory level that is being kept.
Correct, and that's the reason actually because they pushed out because of very rational inventory, they had pushed out some orders, and that's why we are ending up with higher inventory at our level.
Okay, and you mentioned about this, one large product, microfungin, but how about heparins and enoxaparins? So you earlier used to mention about a little bit on the size. So would that have contracted significantly and demand still prevails for those kind of products?
So heparin is mostly price driven, and we consciously took a call that we will not go for very low margin because it doesn't make sense utilizing the capacity for low margin. So that's for the heparin. Enoxaparins still have grown as a number of units have grown, but some markets the pricing is low. So the revenue has gone down by about 10% for Enoxa as a company, but the volumes have gone up by about 7%.
Okay, and heparin, sir?
Heparin actually we have gone down in terms of units. That's a combination, I would say, of price and also last year there was a lot of sales the last quarter because of COVID. So I think it's a combination of both.
Okay, lovely. Thank you. I have more questions. I'll join back.
Thank you. The next question is from the line of Neha Manpuria from Bank of America. Please go ahead. Neha, your line has been unmuted. Please go ahead with your question.
Yeah, can you hear me?
Now, please proceed.
Yeah, sorry about that. Sir, could you explain to us what is the sort of the one-off impact, if at all there is any, in the quarter, and what should be the base that we should be working for when we look at a normalized business, given there was Penem shutdown, etc., that we saw in the quarter? Hello?
Management, we are unable to hear you.
So on the revenue side, I think the one we called out is that Penem line shutdown. So that should be around 30-40 crores is impacted. And I think on the others is also the ROW and all what you mentioned is seasonality. So on the expense side, we had spent a bit on the M&A for closure. And
understood. So even if I were to adjust this 30-40 crores, when you say seasonality, does it mean that some of the sales have probably slipped into, the first quarter as against last quarter?
Yeah, it could be last quarter or the next quarter. For example, one of our the ROW tender, which we're supplying substantially. So those quantities, some going the next quarter, and new tender coming up, which you participated now. So because of that, there's a shift in which quarter it got sold.
Okay. So there could be some bit of it which comes back in first quarter or second quarter.
Yeah, correct.
Okay. But overall, we haven't lost any tenders in our ROW market versus last year, right? Or let's say versus last quarter.
Tenders, no, we have not lost the tenders, but we, like I said, heparin, we intentionally reduced our sales because the margins are pretty low for that, and compared to the cost of holding those inventories and committing to the volumes larger, for a longer period of time, it's a lot more riskier because the margin profile is low for these supplies. So we stayed away from that. But otherwise, from a tender perspective, we are not lost money.
Understood. And I think in the opening comments you mentioned about strategic shift at some customers. Could you quantify? Are there certain customers stop taking supplies from Gland, and therefore we are looking for alternate, supplying these to alternate customers? Is there some amount of lost sales that we have seen because of these strategic shift that you're talking about?
So one customer has shifted almost 14-15 products, exited this market, but that's not an immediate. So they did give us time. So we are actually already shifted some of these products to another company, and a few more to be shifted, but they continue to have those 3 or 4 larger products. Still continue to sell those. The other company which we mentioned was going to file a bankruptcy. It's in the public domain. So that those products are still, they are going for liquidation. If somebody buys, then that business will continue. Otherwise, whoever buys it, that business should move to them. So that we are not yet clear how that business goes. But that's the only, I think, business where we don't have clarity yet.
And, would you be able to quantify in the first case the 14 to 15 products? What is the size of that in terms of, number, for us to understand how this will move?
The customer which gone to the bankruptcy?
No. The 14 to 15 products that you mentioned, the customer shifted to another player or has shifted out from that.
That's already been shifted. Most of the products have already been shifted and getting relaunched the next quarter. So we can't really quantify yet on how that goes, but we're pretty confident of that business doing okay.
Okay, so that will come back in the subsequent quarters for us as we shift it to other customers.
Correct.
Understood. Okay, thank you.
Thank you. The next question is from the line of Shyam Srinivasan from Goldman Sachs. Please go ahead. Shyam, you may proceed now.
Yeah. Are you able to hear me? Hello?
Yes.
Yeah, great. So my question was on the core markets and the divergence between whatever US versus, say, Europe and the rest of the markets, right? So full year, I think US has declined 7%. These other markets have declined higher. And I think for the quarter, maybe there is a lot more convergence. So just want to understand the differences between these two markets, and is there something that is specific that is driving on a full year basis, like the weakness in non-US core markets?
Not really. I think it's a question of timing and what kind of products. And like you said, heparin is the largest product for us. And if you see as a company, we lost over 150 crores for that. And that, I think ROW, that's one of our major products as well. So because of the pricing, we didn't participate or we didn't want to supply for many offers what we got. But I think it's more to do with which quarter we sell. And also we should include last year. If you're comparing with last year, there were also sales pertaining to COVID, like you said.
So do you, Mr. Sadhu, do you see any divergence in the pricing pressure between these two core markets? Or you think it's just a function of which product is when, and if there is a COVID element? It's so difficult to get an underlying trend saying, okay, US is, say, whatever pricing pressure, and the rest core is higher, lower?
I think the price-wise, if you see as a company, both markets, we see like the 1% increase if you look at the pricing for these products. So, although the growth didn't come from any new products, like you said, but the price reduction, when you see the revenue bridge, the margin gap, it's 1% lost because of the pricing. But it's mostly because of the revenue, the degrowth, we are not able to absorb that the fixed cost what we have on the sites. That has impacted the margin. And that's the reason why from contribution margin was still we're at 54%. So some pricing and material price, still it's okay.
Got it. Helpful. Second question is just on the supply of your raw materials and stoppers for individual. So can you just comment on where are we in the journey? Pre-filled syringes, stoppers. Do you face any constraints today? And if you were to look at fiscal 24, you've also talked about inventory for both finished and I think raw materials being higher. So are we good on that, and we shouldn't see a supply shock like what we saw last year?
From I think supply side, mostly it's I would say 90% stabilized. Few products, filters and tubings on and off, but not a major. I don't think there's any major issue on that side.
Got it. So, Mr. Sada, I know you're not giving a quantitative number for top line, so it's just a question of getting the demand now, either say let's assume ROW through the tenders. If you were to since supply is not a constraint, you can now start looking at being, if I use the word aggressive, to try and get demand because supply is not an issue. Would that be a fair statement to make? And as you look forward, also you're getting this NXC, about 25 million euro per quarter coming through. Roughly, I'm just quarterizing an annual number. So is that how we should broadly think of fiscal 24? I know you're not giving a number, but help us construct the revenue bridge for say 24. That will be useful. Thank you.
Yes. So absolutely. I mean, one is working with the partners closely on the front end pricing, how it's going to work. Because the market landscape is different compared to earlier. The assumptions what you made earlier when the product gets genericized and with what price you go and bid, that's completely different now. So there are also opportunities lost because they were assuming that the prices won't fall that long. Although we had leeway in terms of a cost and transfer price and what we could have made a bid for a contract. But because assumptions went wrong, our partners couldn't get those bids. Now we are working closely with them compared to other bids, what price they are at and what price we can offer and what are the internally how much we can go down in terms of transfer prices if there is a need. So we are working very closely with them and aggressively looking at each product where we have lost market share. So we have actually mapped which are the products which we lost substantial market share and the reasons behind that, and we are working towards that. So that's one big action that we're taking. And of course, Synexi is a big focus for us because that market we have never penetrated, and this is an opportunity for us. Several business opportunities we are looking at, and already there are different discussions happening with companies how to move products there. There's also other angle where we are able to talk about taking products from Gland through this acquisition. And like you said, of course, there's a consolidation that's going to happen with the regular revenues what we're generating today.
All right. Thank you and all the best. Thank you.
Thank you. The next question is from the line of Saran Mukherjee from Nomura Securities. Please go ahead.
Yeah, hi, good evening. So can you share the impact that can potentially come from your partner who has filed for bankruptcy, assuming that those supplies get impacted?
So hopefully, because they have gone for a liquidation and people are looking at aggressively how to get the contracts. In fact, there are also customers who are reaching out to us without knowing the bankruptcy process whether they can buy up the contracts because there are 3 or 4 products where they have a GPF contract attached, which has a good value. So it could be a temporary impact where supplies are stopped because we also need to recover the money. But I think long run, it's really protected because it is under this process where if somebody acquires it, they have to acquire the contract where they have to pay the cure money and also they get rights for the GPO contracts where they get transferred. So hopefully, short run it might be an impact till the time its process ends. The dates are end of June. By the time the sale process should complete, so we should get a clear idea of who's going to get these products, and if the business is somebody's going to buy the business in total, or somebody's going to buy products or the contracts.
So I was just wondering, in case, in the interim you are not supplying, right? So somebody else is probably meeting the demand at this point. And if that is the situation, then why would someone buy those assets? Because the value would keep eroding as time passes. So
the business has not stopped. While they have removed a lot of people, they still kept the quality, regulatory, and commercial staff. And there's also inventory lying in the channel. So that's been supplied. So they have inventory of almost 4 months or 5 months. So that's not a problem. So there's no stoppage of business. Business is running as usual. It's just that receivables are going into escrow account where we get our help. So that's not an issue.
And sir, you're not sharing the number, but is it a meaningful number in the sense, is this one of the large partners that you have? I just, in the case of an eventuality, there is a disruption, it could have a meaningful impact, or you think it would be a smaller?
So the business what we do with the customers is around 200 crores per year.
Okay.
Yeah, and then we're pretty much confident that it's not 100%, maybe 70-80% should come back, at least for the products where they have GPO contracts in place.
Okay, understood. Then on the Cenexi acquisition, the numbers that you disclosed imply that the EBITDA has come down materially for the second half. So I know when you did the acquisition, you did mention that first half was inflated. So if you can give us some indication as to what's the right level of EBITDA for Cenexi that we should work with.
Yes. So Sam, like last time when we spoke about the Cenexi, we told that it's a half year is not indicative of the full year. However, the second half of the calendar year 22 has also been impacted because of the high energy cost, which we are expecting to improve now because that is now kind of behind them. So in terms of revenue, they have definitely grown. And EBITDA margin is currently the full year what we have achieved and should be better. I think that's what the projection is. I cannot give a number right now, but because of the cost factors, it's going to improve, and the product profile which they are currently working on is in a better margin profile than the previous year. So numbers we'll talk about later on once we have a full clarity on the plan.
Okay. And finally, if I can, on, sir, you mentioned about competition in heparin and enoxaparin, particularly in heparin, right, where it has come to a level which is not very lucrative for us. So how important are these two products now? I remember, initially it was very important. How big contributor are these two products to your overall revenues? And if you can give some color on, what is really driving it. Are these the Chinese player who are beating down the price? Do they have some cost advantage which is leading to this sort of erosion?
Yeah, absolutely. So if you see heparin as directly now, the two Chinese players have directly launched in the US. So that's one major roadblock, I would say. If you look at from a number perspective, heparin for the company is around 50 crores in FY23. But that's for the company. But we are working on a strategy where we have 9 SKUs, whereas a lot of other companies do not have 9 SKUs. We're seeing how we can increase that volume going on, looking at as a basket instead of an SKU level. So we are working on that as well, and we are also working with our own parent company subsidiaries and qualifying their crude to get a better pricing. So once we get that approval, I think we'll be in a better position than now.
And the same situation is enoxaparin as well?
Enoxaparin, US, what happens is, of course, they're again direct supplies from China. There's a competition in that. The compliance of the GPO is not there yet. Although our partner has a regional contract, the compliance is around 55-60% as against normal 85-90%. So the offtake is not as per our estimate, which kind of impacted our pickup of this stock this year because they had a larger inventory last year, and they are rationalizing that inventory that has impacted. But I think it's not this quarter, next quarter, not June quarter, but probably September quarter it will start picking up the product from us.
Okay. So can you share the total contribution for heparin and enoxaparin for FY23 for the company?
So the company for enoxaparin and heparin together is 970 crores.
970 crores. Okay, sir. Thank you.
Thank you. The next question is from the line of Ananda Padmanabhan from PGIM India. Please go ahead.
Thank you for taking my question. So just to understand, in Q1 we will continue to see the impact of production shutdown, or so that would again be a factor that would play in the next quarter as well, if I have to understand that right?
No, it started now. From May 15th, the line is back on track in commercialization. So probably half quarter impact, but it's back on track. But as against earlier 2 lyos, now we are producing 3 lyos. So that should make up for the quarter number.
Okay. And with respect to Cenexi acquisition, by when do you expect the acquisition to get closed, completed?
It's already closed last month.
Or by when should we expect? So Q1 itself, we should see the consolidation happening?
Yeah, we'll consolidate this year, the next quarter, for 2 months, because we closed on April 27th. So the consolidation happens the next quarter for 2 months, May and June, for 2 months. Yeah.
And sir, heparin and enoxaparin for FY22, how big were they? The contribution of heparin and enoxaparin for FY?
Around 1100, about 1100.
1100. That is
1200.
FY20.
Yeah,
correct?
FY23 it was 1200 and FY23 is about 980. 970 to 980. Yeah.
Okay. And in US, do you see in terms of the pricing pressure, or in terms of there are some news flows of some key players, facilities getting impacted because of because of regulatory action? Are you seeing any impact of the same in terms of customer inquiries for newer contracts or in terms of demand?
So the volumes of several products have gone up because of this. The pricing has not gone up that much, but we had some of the products, the volumes have gone up, and I think more and more we are getting queries on certain products.
Okay, thank you, sir. I have a few more questions. I'll come back to the queue.
Thank you. The next question is from the line of Bino Pathiparampil from Elara Capital. Please go ahead.
Hi, good evening. Just a clarification on your inventory levels. It seems to have gone up significantly. Why?
Yes, like I said, because of the cut down of inventories at our partner level, so it got pushed out by a few months, and that got added up at our end. And because of this situation of last year, we're trying to keep up a little more inventory than usual. And like you said, for heparin and enoxaparin, there's a lot of inventory with us. One is anticipating the pickup from next quarter onwards. The other is, we don't want to sell at a low price. So once, I just talked about how we want to manage US situation. Once that gets finalized, then we will start utilizing that. But yeah, we are focusing on that and seeing that how to reduce that inventory for sure.
Okay. And this customer who has filed for bankruptcy, did their takeoff from you decrease significantly in Q4 compared to Q3?
Not big way, but I would say probably 25-30%, because we actually started reducing supplies, looking at the receivables to reduce the receivables. So we kind of reduced supplies. Yeah.
Understood. And the other customer who exited the business, when did exactly they stop taking products from you? Which quarter was that?
It's this quarter, the previous quarter, and but we have already transferred those products and getting launched the coming quarter. So some are getting launched in June and some are getting launched in July.
Yeah, sorry, but when did they stop taking products from you? Was it 4Q or 3Q or 2Q?
4Q, last quarter.
Okay. Okay, thank you.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Yeah, thank you very much, and good evening, sir. First of all, what was the profit share for the quarter and for the full year?
You want the full year?
Yeah, Q4 and full year. I remember it used to be around 10-11%, so has this materially changed?
Yeah, so full year is 8% and quarter 4 is 7%.
Okay. So that's a straight 300 to 400 basis point hit to your margins, no?
Yes.
And this is all the impact of the end market price erosion, which is now getting filtered down to you as a supplier.
Yeah, so it's both actually, because along with that, there is also the impact of the high margin inventory, lowering at the customer end, which we were talking in the beginning.
Yeah, which means the revenue mix. So the high margin stuff is kind of not moving.
1 second. Yeah, so and the product mix also, so like products like mica has high profit share.
So where do you go from the 7% now if you look out in the future? Is this a new level, or you think you're going to get back to your previous levels?
From profit share perspective?
Yes.
I think it all depends on, currently so much shortage is happening, so probably the pressure on some of these products are not that much. And the mica, now it has gone away. So, like I said, it's from 440 crores, now it is like 65 crores. So the volume should increase a bit, because it's also considering the high inventory they held last year. So they were using that inventory, that should go up. So I would still feel that it should settle around 10%.
Okay, that's very good to hear, sir. And so the second question, you're talking about the end market pricing pressure. So your customers are sort of losing market share. So you want to sit down and plan the price volume metrics. I wasn't too sure that I understood your comment fully. So what percentage of your business does that planning, apply to? And does that mean that we should brace for a sort of portfolio-wide or something price erosion in fiscal 24 as your plans, get finalized with the customers?
So I think, we can't very generalize on same plans for all products, right? So you see that three or different kinds. That's why we are getting each product level. Some products actually there's a lot of margin where the customers can pay, but they don't want to do it. So let's see to the customer and what's the logic behind not going after the higher market share when there is a high margin between the selling price and cost. There are also products where probably our transfer price a little higher, where we have worked on reduction of cost over the last 12-18 months. Part of our, I would say, 30-40% of our R&D cost goes into lifecycle management where we reduce costs. So there we can actually go after a higher market share. So there are different factors for different products. That's what we are trying to do, which products we have lost market share or where we have lower market share and where there is a possibility to increase those volumes. So there's no one solution for all products, but each they actually differently.
No, fair enough, sir. But what's the average picture? What should we expect in fiscal 24? Just roughly about, is it about lower pricing, higher volumes for the base business, and what percentage of your business is getting impacted? Is it like 20%? Is it 50%?
No, we can't really give a number. That's what I'm saying. We also have some high margin products where the volumes currently are not that much, and we are trying to see how we can increase those kind of volumes also. So some partners, they really don't want to go after a competitive bid. They don't want to even participate bid. So we have to sit with them and say how to get into these kind of bids and stuff like that. So it's a combination of both. One probably where we still have margins where they can go aggressively for market share, or where probably the volume is helping to absorb our fixed costs, even if the margin is lower, but if it's going to absorb, so at the EBITDA level, it's going to help the company. So it's a combination of both.
Okay, got it, sir. So one final question. So not too far back, maybe 6 quarters back, your operating margins used to be 35%, and this quarter it's 21%. It's a very, very big move. So how should we think about it? I'm not looking at next 2 quarters, but like in a year or two, how is the business going to evolve, and what's the right range? Any guidance, any qualitative, points on this would be very helpful. Thank you.
I think it's a combination of the lower base also, because of costs, they're almost fixed. Like I said, they're only added costs in the retail transfer. It's not commercialized. So these lines will get on track next few quarters. Now the revenue base is lower, but the costs are similar, a little higher than last year. And that's why it has gone down. Once your revenue base becomes normalized, then this will automatically goes up.
Yeah, so it's like the leverage impact which has affected us. Injectable cost, most of it is being fixed, and inflation and power cost has gone up. While the gross margin percentage remaining similar, EBITDA impact has been direct because we are dividing by a lower base of revenue now, but the cost has gone up.
And also, if you see the R&D cost, because the base is lower, we spent like last quarter is almost 7%, because of the complexity of products what we are dealing today. Our original plan was to stick around 4 to 5% with the normal growth what we have as a company. But because our base is lower now, that's showing at 7% and it's showing that lower EBITDA number, because the absolute number is still as per the plan. And then as for the year, normally I think it's higher this year is around 5%, 5.6% or something. Historically it's been around 3.5 to 4%.
Okay, got it, sir. Thank you so much.
Thank you. The next question is from the line of Alankar Garude from Kotak. Please go ahead.
Yeah, hi. Good evening, everyone. Sir, in the past, we used to be quite confident of the growth trajectory in ROW. Would you still maintain that ROW will grow at a significantly faster pace for us, say, compared to US?
So the base has gone up. You can see last year a substantial increase in the base. And that's why you see, and the US business is very large, and that's why the percentage growth looks smaller. But the efforts are there how to increase the growth in especially the Asia and MENA markets, where we see substantial opportunities opening up there, even compared to LATAM.
Understood. And sir, has there been any meaningful change in the gross margin profile across geographies in the past 1 year? Because I remember a couple of quarters back you had talked about ROW margins being significantly lower than US, as well as the other regulated markets.
I think it's in the similar range it used to be. In fact, the price pressure in US is was larger, whereas other markets it's still, except for one or two products, but mostly it's been stable.
Understood. And sir, final question, quite similar to the previous question. So if we go back a year, we were guiding for about 20-25% top line growth with a 35% EBITDA margin for FY23. Now versus that, we have delivered about 18% drop in sales with about 28% EBITDA margins for the full year. So while we are not giving a numerical guidance, would it be fair to say that structurally this is the new normal now, or we are very close to the new normal now?
I can't really say that because like I said, it's been a very dynamic situation out there. With the high interest rate, people are looking at how much inventory they have to do it, and now the inspections start happening. We have to see how that's going to play out. You have seen 3 or 4 big players having issues in the US. So is it going to come back to maybe 4 years back where the companies had these kind of issues, or is it going to settle? It's very difficult to tell. We have to see how strong from the company perspective, from regulatory perspective, from quality perspective, from development pipeline perspective. We're doing the best what we can, and we're filing more than actually what we were doing before. We're always guiding around 23, 24 ANDAs. We filed 29 NDAs. So we're not stopping in that. We are moving on the complex side. We filed 3 complex injectables. The microsterile is ready. So in that sense, as a company, structurally, as a company, we're strong. And I would say, better than a lot of other companies are going through this process. Now, from market dynamics, we have to wait and watch because of the competition, and some are exiting the market. So naturally, it could be a shorter impact for us, but the same people maybe we're importing the products from others and selling in the market. So there, the competition has reduced. So either, one way it might be disturbing for us to see that some business is lost. Positively, we are thinking, well, let's see positively, they're also exiting several other products where they're more competitive for our own products. So probably, there's an opportunity for us there. So it's a give and take. There could be a temporary issue with us, but in the long run, if the competition is going down or exiting the market, so we positively should think that maybe it's going back to 3-4 years ago where there were lesser competitors with these guys exiting the market.
Okay, sir. Thank you and all the best.
Thank you. The next question is from the line of Parth Shah from Bernstein. Please go ahead.
Hi, this is Nitya. Thank you for the opportunity. One question on the line shutdown. So we saw an insulin line shutdown earlier in the year and then a penem line shutdown. Are these planned line shutdowns or unanticipated ones? Why, given the substantial nature of these shutdowns, is this something that can be communicated to the market in advance? And what can we expect next year? Are there any planned shutdowns?
So from the tenant's perspective, this line, we've been contemplating, but it was we've been holding up because of the supply situation. We didn't want to disturb the market for a while. While we have put up the Layo, but we never connected to the line. But if you see our own the Atropine product, we have doubled our revenue last year. And there's an opportunity to still grow there. So we thought, we'll take one-time hit, but then there's an opportunity out there to take it. And that's the reason why we took that call and took the shutdown. So the timing was not very clear when we wanted to do it, but we did that. So I think so that was the reason for it. But in the near future, we don't have plans to take a shutdown, at least a planned shutdown. Unplanned, of course, we don't know.
Got it. Thank you. The next one on heparin, I didn't quite comprehend your comments. So last quarter, you had mentioned that at least from a U.S. perspective, the demand was still intact, and your ability to supply was what was constrained because of the coated stopper non-availability. Is the U.S. demand still intact, and have you solved for the coated stopper issue, and will we see heparin in the U.S., the revenues from heparin in the U.S., will it be back in FY24, or how should we think about it?
Heparin in U.S., the impact was, like I said, in 9 codes, 30 ml is the largest code what we sell. And that continued to sell. So that stopper issue has gone away. So we have enough to supply now. So that's happening. but we are not selling too much of the other codes. That's why now we are focusing on how to get back into the other 7 or 8 codes to increase that business. The revenue impact for heparin has come more from India and ROW in this year.
Got it. And one quick one on enoxaparin. So enoxaparin, again, last quarter you had mentioned, Sadhu, that your run rate is approximately $50 million. And as the rest of the hospitals as well convert to your product, that can potentially go up to $70 million. Do you still anticipate that to happen in FY24?
So Nitya, that's what I told, the compliance, what we thought of getting to 85-90, the compliance level is only around 55%. So the estimated volumes around 20-23 million, that is standing around 15-16 million. So the efforts are made how to increase that compliance. So the partner is discussing with the GPO because that's not a fair thing that you only have 55%. So that's work in progress. But as of now, the forecast is like around 15-16 million as against 23.
Understood. If I might just squeeze one very short one, do you anticipate any substantial increase to the cost items in terms of any investments, plant-related investments you anticipate to make in FY24, or are most of the costs in the P&L already?
So P&L costs are all taken in. There's no incremental costs which will come up because of new plants coming into commercialization.
Thank you so much.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mrs. Sumanta Bajpayee for closing comments.
Thank you everyone for joining us today. We appreciate your participation during the call, and we request if you have any clarity, please reach out to me. Thank you again. Good night.
Thank you. On behalf of Gland Pharma Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.